Welcome back to the deep dive. Today we are standing at the edge of a cliff that I think terrifies most people. You look over the edge, and it's just this swirling vortex of Greek letters, complex mathematics, and you hear these stories of people losing their entire fortunes in a single afternoon.
It's the part of the map that usually says, "Here be dragons."
Exactly. We are talking about options, and I don't mean options like, picking a restaurant for dinner or choosing which shirt to wear. We are talking about financial options. Derivatives. The stuff that makes the news for all the wrong reasons, but it's also the stuff that, well, it powers the entire global financial system.
It really is the engine room. It's noisy, it's dangerous if you touch the wrong pipe, but it's absolutely what drives the ship forward.
And to help us navigate this engine room, we are diving into Chapter 4 of the NISM Equity Derivatives Certification Workbook. This is the real deal.
This isn't a blog post.
No, this isn't a get-rich-quick thing you find online. This is the actual certification material that professionals in India have to master to get their license to trade. So, we're going straight to the source.
And what I love about Chapter 4 specifically is that it marks a massive psychological shift. If you listen to our breakdown of Chapter 3, we talked about futures. And futures are, well, they're logical. They are linear.
Right.
You buy, the market goes up, you profit. Market goes down, you lose. It's a very clean seesaw.
Symmetrical. It feels fair in a way.
But Chapter 4, it throws fairness, or at least that kind of symmetry, right out the window. It introduces a non-linear world, a world where the inputs and the outputs don't really match up in a straight line.
Okay.
It's a world where you can control a massive asset cores of rupees worth of stock without ever owning it. And here's the concept that usually breaks people's brains. You can structure a trade where your risk is strictly limited to a tiny amount, but your profit potential is, well, theoretically infinite.
See, that sounds like a scam. I mean, if I got a WhatsApp message saying limited risk, unlimited profit, I would block the number instantly. How is that even possible in a regulated mathematical market?
It feels like magic, but it's actually just contract law and probability theory working together.
Yeah.
But you are right to be skeptical. I mean, there is no free lunch. You gain that superpower of limited risk, but you absolutely have to pay for it.
Okay.
And understanding what you are paying for, who you are paying, and how that price is calculated, that is our mission for today.
We are going to decode the jargon. We're going to tackle calls, puts, the Greeks, moneyness, all those words that sound like they belong in a secret code. By the end of this hour, I want to understand not just what these things are, but why a rational person would choose an option over just, buying shares.
That's the goal. We need to move from looking at this as gambling to seeing it as strategic risk management. It's a tool, not just a lottery ticket.
All right, let's start at the absolute foundation then. Segment 1 of our outline is the fundamental concept. The source material draws a very, very bright line in the sand right at the beginning. Rights versus obligations.
This is it. This is the DNA of the entire market. If you don't understand this distinction, you simply cannot understand options. It's the core principle.
So break it down for us.
An option is a contract. But unlike a future, where both parties are locked in, almost handcuffed together, an option gives one party a choice. It gives the buyer the right, but crucially, not the obligation, to buy or sell an asset at a specific price on or before a specific date.
That phrase, not the obligation, that is the superpower, isn't it?
It changes the entire physics of the trade. It really does. Compare it to a future. If you and I enter a futures contract where you agree to buy the Nifty index from me at 18,000 next month,
Right.
You're locked in.
No way out.
None. If Nifty crashes to 10,000, too bad. You must buy it at 18,000. You have an obligation. The market, frankly, doesn't care about your feelings.
I'm on the hook.
You're on the hook. But with this option, you hold the key to the handcuffs. If the market moves against you, if the deal no longer makes any financial sense, you can just walk away.
Just let it go.
You don't have to exercise the contract. You can let it expire worthless and just wash your hands of it.
That is a massive advantage. So I get all of the upside if I'm right, but I can just shrug my shoulders and leave if I'm wrong.
But I assume the person on the other side of this trade isn't doing it out of the kindness of their heart.
Definitely not. And this brings us to the two characters in this little drama. You have the buyer, also known as the holder, and you have the seller, who is also called the writer.
Okay, let's profile them. I'm the buyer. I want the superpower. What do I have to do?
So you are the one who wants the right. You want the choice to walk away. To get that privilege, you have to pay a price upfront to the other party. We call that price the premium.
The premium. So that's the price of admission to this ride.
Yeah.
Think of it as the price of the option itself. It's the cost of having that choice. And here's the key. Once you pay that premium, your risk is done. That is the most you can possibly lose. That's it. If the market crashes, you just let the option expire. You lost your premium, say, 100 rupees, but absolutely nothing else.
Limited loss.
Limited loss. But if the market moves in your favor, you participate in that entire ride. Your profit is potentially unlimited.
Okay, now flip the table. Who is the crazy person taking the other side of this bet? The seller, the writer.
The seller or the writer is the one who receives that premium. They pocket that cash immediately up front. But in exchange for that cash, they sell away their choice. They take on an obligation.
So they are the ones in the handcuffs.
Yes. If the buyer decides to exercise their right, the seller must fulfill the contract. They have absolutely no say in the matter.
So let's look at their math, their P&L. The most they can ever make is the premium I paid them at the start.
Correct. Their profit is capped. It's limited to the premium received.
But if the market goes wild against them...
Yeah. Their loss is potentially unlimited.
Whoa, stop there for a second. Why would anyone ever accept a deal that is capped profit, unlimited risk? That sounds like the worst business proposition in history. Here, take 100 rupees, but you might lose your house. Who signs up for that?
It does sound terrifying on the surface. But think about the insurance industry. An insurance company collects a small premium from you to insure your car.
Right.
If you get in a big crash, they lose a huge amount of money replacing your car. They have capped profit, which is your premium, and massive risk, which is the value of the car.
But they do it because most people don't crash their car.
Precisely.
Mm-hmm.
Sellers are playing the probabilities. They are betting that the unlimited risk event won't actually happen, and they can just keep collecting those premiums as a steady stream of income. They are, in essence, the casino.
So the buyer is the speculator and the seller is the casino.
That is a very, very apt analogy. The buyer is looking to the jackpot. The seller is the one playing the house odds, day in and day out.
All right, so we have our players. Now let's talk about the instruments themselves. Calls and puts. I feel like these terms confuse people just because they're such short words that don't really sound like what they do.
They're simpler than they sound. A call option is the right to buy. A put option is the right to sell. That's the fundamental difference.
The NISM workbook uses a real estate analogy for the call option. I actually found that really helpful to visualize this whole thing.
It's the classic token money concept. Let's walk through it. Imagine you see a plot of land you really like. The seller wants 1 crore for it.
Okay.
You think the government is about to announce a new highway project nearby that will double the price of that land? But you aren't sure. It's a hunch.
So I don't want to buy it yet. I don't want to drop a full 1 crore on a maybe. That's a huge risk.
Right. So you go to the owner and you say, look, I'll give you 1 lakh rupees right now as a non-refundable deposit. In exchange for that 1 lakh, you give me the exclusive right to buy this land from you for 1 crore anytime in the next 3 months.
Okay. I've paid the premium, 1 lakh rupees. The contract is live. My choice is now locked in.
Scenario A. The highway is announced. You were right. The land value immediately jumps to 1.5 crores.
I exercise my right. I call the owner and say I'm buying. I buy it for the agreed upon 1 crore. I can immediately turn around and sell it in the market for 1.5 crores. I've made a 50 lakh profit minus my 1 lakh deposit.
That's a massive, massive return on your investment of 1 lakh.
Yeah.
Now, scenario B. The highway project is canceled. The land value drops to 50 lakhs.
I look at my contract, I look at the land, and I just walk away. I tear up the contract. I lose my 1 lakh deposit, my premium. But I save myself from buying a losing asset and losing 50 lakhs.
That is a call option. You're betting on the price going up. You have a bullish view.
Now, the put option, the right to sell. This is the one that people use for protection, right? For hedging.
Yes. This is your car insurance. When you buy a comprehensive policy for your car, you are effectively buying a put option from the insurance company. You are paying them a premium for the right to sell your car to them at its insured value, even if the car is a mangled wreck on the side of the road worth 0.
So I profit, or rather I'm protected, if the value of my asset crashes.
Exactly. Traders buy puts when they're bearish, when they think the market is going to tank. It's a way to insure your portfolio against a downturn.
Okay, that makes sense. Rights, obligations, calls, puts. Now, there is a technical distinction in the source material about exercise styles. American versus European. This isn't about where the trade happens, is it?
No, not anymore. Historically, yes, but now it's just about the rules and engagement regarding when you can use your power, when you can exercise that right.
Okay.
American option is very flexible. You can exercise your right at any moment on any day during the contract's life. If you wake up on a Tuesday and feel like exercising, you can do it.
And a European option.
European options are much stricter. You can only exercise your right on the specific expiration date, not a day before. You cannot trigger the settlement early.
And the workbook has a crucial fact alert here for the Indian market, which seems important.
It does, and it's a big one.
Yeah.
In India, all stock and index options are European style.
So that's a big deal then. If I buy a call option on Reliance and the stock spikes in the middle of the month, I can't just call up the exchange and demand the shares immediately.
You cannot demand settlement from the exchange. However, and this is a very key distinction, you can trade the option. You can sell that valuable contract to someone else in the market at any time and book your profit.
Ah, okay.
You just can't force the physical exercise and delivery of shares until the very end on that expiration day.
Got it. So liquidity allows me to exit and take my profit, but the contract structure itself locks the final obligation date.
Perfectly put. It just simplifies the back-end mechanics for the exchange and the clearing corporations.
Okay, let's open up the hood now. Segment 2. Decoding the contract. If I'm looking at my trading terminal, I see a string of numbers and letters. You know, Nifty 18400 CE, Premium 120. Let's parse this. Let's break it down.
Let's break down the specs. First, you have the spot price, S. That is just reality. It's the current market price of the underlying asset right now, this very second. If Nifty is trading at 18,315, that's your spot.
Then you have the strike price, X.
This is the anchor, the pre-agreed price in the contract. If you bought the 18,400 call, then 18,400 is your strike. That is the price you are promised, no matter what the market does.
And the premium, we touched on this. That's the price tag for the option.
Yes, but there is a multiplier effect here that really catches beginners off guard. Options trade in lots.
Right. I can't just buy an option for one single share of Reliance or one unit of Nifty. It doesn't work that way.
No, that would be an administrative nightmare for the exchanges. For Nifty, the current lot size is 50. So if you see a premium quoted at 100 rupees, you don't write a check for 100 rupees.
No, I write a check for 100 times 50, so 5,000 rupees for one lot.
Correct. And this is vital. Your P&L, your profit and loss, is also multiplied by that lot size.
Yeah.
A 10 rupee move in the premium isn't a 10 rupee gain for you. It's a 500 rupee move in your account. This is the first layer of leverage.
No, let's talk about time, the trading cycle. How far out into the future can I buy these contracts?
For equities and indices in India, we follow a pretty standard 3-month cycle. At any given moment, you can trade the near month, which is the current month, the next month, and the far month.
And the death date, the expiration date, when do they just vanish?
The last Thursday of the month. That is expiration day. If Thursday happens to be a trading holiday, it bumps back to the previous trading day, which is usually Wednesday.
And we also have weekly options now, which I see everyone trading on their phones. They seem incredibly popular.
Yes, especially for the big indices like Nifty and Bank Nifty. They expire every week, usually on a Thursday. It has turned the market into a much more fast-paced, almost tactical environment.
So it's like playing blitz chess instead of a long tournament game.
That's a great analogy. The time decays much faster, the moves are quicker, and the potential for rapid gains or losses is amplified.
One detail on settlement that scared me a bit when I was reading the book, it says stock options are physically settled. That sounds physical.
It is, and this is a trap for the unwary. It's really important. Index options like Nifty are cash settled. No one delivers a box of Nifty to your house.
Right.
It's just money credited or debited to your account. But stock options,
If I hold a call option on Reliance stock to expiry,
and it is in the money, meaning it's profitable to exercise, you are now obligated to take delivery of the actual shares.
meaning I need the cash for the shares.
Yes, you need the full cash value of those shares in your account. Not the small premium you paid, the full value of the stock purchase.
So if I was just speculating with, say, 10,000 rupees on the premium, but the actual shares are worth 5 lakhs, I'm in trouble.
You are in a major margin call situation. The broker will panic. You will panic. So the golden rule for any retail speculator, if you are trading stock options, close your positions before expiry day. Do not let it go to physical settlement unless you genuinely want to own the stock and have the capital.
That is a Blinkist level takeaway right there. Close it out. Don't get caught.
Absolutely. It's a risk you do not need to take.
Okay, let's move to segment 3. This is a concept that helps you orient yourself on the map. Moneyness. It sounds like a completely made-up word, but it basically answers the question, is my ticket winning right now?
Exactly. It just describes the relationship between the current spot price and your contract strike price. It helps you visualize where you stand, and there are three states of existence.
Let's role play this. I'm a call option buyer again. My strike price is 18,400. That's my contract. I have the right to buy Nifty at 18,400.
Okay, now look at the market. The spot price is 18,500.
Okay, so I can buy at 18,400 using my contract, turn around and immediately sell it at 18,500 in the open market. I have a 100 rupee advantage.
You are in the money, ITM. The option has what we call intrinsic value. It represents a real, tangible profit opportunity right now if you were to exercise it.
Okay, scenario 2, the spot price is 18,300.
You have the right to buy at 18,400, but the market is selling it for 18,300. Would you use your special ticket?
No, of course not. Why would I pay 18,400 when I can just buy it for 18,300 in the market? My ticket is useless.
You are out of the money. OTM. The option has zero intrinsic value. If it expired at this exact moment, it would be worth nothing.
And what if the spot is right on the dot at 18,400?
You are at the money, ATM. You are on the precipice, the knife's edge. No advantage, no disadvantage.
And for put options, the right to sell is just the reverse logic, I assume.
Exactly. With a put, you want to sell high. So you are ITM when the spot is lower than your strike. If your contract lets you sell at 18,400 and the market is only willing to pay 18,300, you are winning. You have an advantage.
Okay, this brings us to what I think is the most philosophical and maybe confusing part of the chapter. Segment 4, the anatomy of the premium. Because here is what doesn't add up for me. You just said an out-of-the-money option has zero intrinsic value.
Correct. At that moment in time, it has no exercise value.
But when I look at the trading screen, an OTM option still costs money. It's not free. So why am I paying real money for something that you just told me has zero value?
That is the million-dollar question. And the answer is you aren't paying for value now. You are paying for possibility.
Possibility.
The full formula is option premium, intrinsic value plus time value.
Okay, let's use the numbers from the book to make this really concrete. We have a put option. The strike price is 18,400. The spot price is 18,315.10.
Okay, so you have the right to sell at 18,400. The market is at roughly 18,315. You are winning by, what is that, 84.90 rupees?
Right, so that 84.90 rupees is the intrinsic value. That's the real cash I could get right now if this was the expiry moment.
Exactly. But the pre-jump for that option is trading at 177.60.
So why the extra cost? 177.60 minus the intrinsic value of 84.90 is 92.70. Where does that extra 92 rupees and 70 paise come from?
That 92.70 is the time value. You are paying that extra amount because there's still time left on the clock. The contract hasn't expired yet.
Right.
The market could crash further. That 85 rupee profit could turn into a 200 rupee profit by next week. You are paying for that hope, for that possibility.
So time value is literally the price of hope.
It is. And here's the dark twist. The book calls options a wasting asset.
That sounds incredibly ominous.
It is the villain of the story for the option buyer. Time value only moves in one direction, down. As you get closer and closer to the expiration date, the possibility shrinks. The window of opportunity is closing.
So it's melting away.
At the exact second of expiration, there is no more future. There is only now. So time value becomes zero. It evaporates completely.
Like an ice cube sitting on the counter.
Perfect analogy. It is melting every single minute of every single day.
So if I am a buyer, I am in a battle against the clock. If the market just stays flat, I'm losing money every single day because my time value is melting.
Yes. You need the market to move, and crucially, you need it to move fast enough to outrun the melting ice.
And if I am the seller, the one who sold the option,
you are the one sitting there happily watching the ice melt. You collected that time value up front. You want the market to be boring. You want the clock to run out so you can just keep the whole premium.
That really clarifies the battle lines. The buyer needs action and volatility. The seller profits from inaction, or at least from stability.
That's a great way to put it. Sellers are, in essence, selling time. Buyers are buying volatility and hope.
Let's get visual. Segment 5, payoff profiles. This is where the rubber meets the road section of the book. The source material has these graphs that look like hockey sticks. Let's try to describe them for the listener.
Let's start with the most common one, the long call. That's just buying a call option. We call this person the optimist.
They have a bullish view. They think the market's going up.
Exactly. So your payoff graph starts below the zero line. Why? because you paid the premium to enter the trade. That's a sunk cost. Let's say the book's example says you paid 95 rupees.
So my P&L starts at -95.
Yes. And if the market goes down or stays flat or even goes up just a little bit, you stay at -95. That is your floor. You can't fall into the basement. Your loss is capped.
But if the market starts to rally hard?
The line on the graph takes a sharp turn and shoots up diagonally. Once you cross the break-even point, which is simply your strike price plus the premium you paid, you are in pure profit territory. And that line goes up forever.
Limited upside.
Now let's look at the short call, the person who sold that option to you, the risk taker. Their graph is a perfect mirror image. They started at +95.
They pocketed the cash.
They have the cash.
Yep.
But as the market goes up, their line goes down and down and down, crashes through the zero line, through the floor, into the basement, into the bedrock.
Unlimited loss.
This is why selling naked calls, which means selling without owning the underlying stock to back it up, is often called picking up pennies in front of a steamroller.
I've heard that.
You get to keep the penny, which is the premium. But if the steamroller, the market rally, catches you, you are completely flattened.
And for puts, it's a similar logic, but for a down move.
Exactly the same logic. The long put buyer pays a premium to bet on a crash. If the market tanks, they profit. Their max loss is just the premium they paid. The short put seller collects that premium, betting against a crash. If the floor falls out of the market, the seller's on the hook to buy that asset at the much higher strike price.
The book mentions leverage again here. It calls it a double-edged sword, which seems appropriate.
It's vital to get your head around this. Because options are so much cheaper than stocks, you can control a much larger number of shares with the same amount of capital. A small 5% move in the underlying stock might result in a 50% or even 100% move in the option premium.
That sounds fantastic when you're right.
It is. But if the stock moves 5% the wrong way, your option can go to zero. You can lose 100% of your capital in a single day.
Mm-hmm.
That doesn't usually happen with stocks unless the company goes bankrupt. In the options world, a total loss on a trade is a common, everyday occurrence.
Okay, so we know the risks. Now let's talk about the mechanics of that price tag itself. Segment 6, the Greeks. I always feel like I'm in a fraternity house or a physics lab when traders start throwing around Greek letters: delta, gamma, theta.
It does sound very academic, but it's really just a way of measuring sensitivity. The price of an option, as we've seen, depends on a few things: the spot price, the strike price, volatility, time, and interest rates. The Greeks just tell us which of those levers is pulling the hardest at any given moment.
Okay, let's decode them one by one. First up is delta. Think of delta as speed.
Speed.
It tells you how much the options price will change if the underlying stock or index moves by 1 rupee. If the delta of your option is 0.5 and the stock moves up by 1 rupee, your options premium will gain about 50 paise. So it's like the throttle. A high delta means a small move in the stock gives my option a big kick.
Exactly. And there's a little probability trick with delta too, right?
Yeah, the book mentions this. It's a kind of trader's hack.
A delta of 0.5 roughly means there's a 50% chance the option will expire in the money. A delta of 0.1 means there's only about a 10% chance. It's a long shot.
That is incredibly useful, so I can look at the delta right on my screen to get a quick sense of my odds. What about gamma?
If delta is speed, then gamma is acceleration. It measures how fast your delta changes.
So if the market starts moving really, really fast, my option speed starts to change.
Yes. Gamma tells you how quickly your position will get bigger or smaller in response to market moves. A high gamma option is very unstable. Its P&L can swing wildly. It's the adrenaline of the trade.
Okay, speed, acceleration. Next is theta, and we've already met this villain.
The Grim Reaper. Theta measures time decay. It tells you in very precise terms exactly how many rupees your option will lose today just because the sun rose and set.
And it's always negative for buyers, right?
Always.
Yeah.
You are essentially renting the position. Theta is the rent you pay every single day for the privilege of holding that contract.
Then we have vega. This one's a bit different.
Vega measures sensitivity to volatility. It tells you how sensitive the option's price is to fear in the market. If vega is high, and suddenly the market gets very scared and choppy, the option price can balloon up even if the stock price doesn't move.
And the last one, rho. That's interest rate sensitivity. Honestly, for most short-term retail traders, rho is the least important Greek. It matters much more for long-term institutional books or if the Reserve Bank of India makes a massive, unexpected rate change. For day-to-day trading, you focus on delta, theta, and vega.
Okay, so segment 7 takes us deeper into this volatility concept. The book mentions pricing models like Black-Scholes. Now, we don't need to do the calculus here, but we need to understand the output.
The single most important output, what I'd call the holy grail for professional option traders, is implied volatility. 4. I hear this term constantly from traders. 4 is high, 4 is low, 4 crush. What is it?
Think of 4 as the fear gauge of the market. Normally, you'd use a model like Black-Scholes to figure out the fair price of an option. But in the real world, traders do the reverse. We see the price trading on the screen, and we ask the math. Given this market price, how much volatility is the market expecting in the future?
So if the options price is really, really expensive, it means the market is expecting chaos.
Exactly. High 4 means high expected chaos. Low 4 means the market is expecting things to be calm and quiet.
The book gives a fantastic example to illustrate this, the pharma company court case. Let's walk through that because it makes it so clear.
It's a perfect case study. Imagine a boring, stable pharmaceutical stock. Usually it moves maybe 1% a wink. Its historical volatility is low, so its implied volatility is also low, say 15%. Options are cheap because nothing much is expected to happen.
But then news breaks. Next week, a judge is going to rule on a massive patent case. If the company wins, the stock could double. If they lose, the stock could get cut in half.
Suddenly, all certainty is gone. The market knows something huge is coming, but it doesn't know what. Traders rush in to buy options for both protection and speculation. They bid up the prices. The IV spikes from 15% to maybe 80%.
So the options become incredibly expensive just because of the uncertainty.
Yes. Now, imagine you buy a call option because you have a strong feeling they will win the case. You pay a huge premium for that call because the IV is at 80%.
Okay, so the verdict comes out, and you were right. They win. The stock jumps 10%.
You should be happy, right? You got the direction right. But watch what happens to the IV. The verdict is out. The uncertainty is now 0. The event is over. The IV immediately crashes from 80% right back down to 15%.
The fear balloon just pops?
This is called an IV flush. And the value you lose from that massive drop in volatility might be bigger than the value you gain from the stock moving up 10%.
So wait, I was right on the direction, but I could still lose money on the trade.
Yes, because you bought when volatility was expensive, and you held it while it became cheap again. You overpaid for the hope.
That is a crucial, crucial lesson. It's not just about being right on up or down. It's about being right on calm or chaos.
The general rule of thumb traders use is this. When 5A is high, when fear is high in the market, you generally want to be a seller of options, collecting those expensive premiums. When 5A is low, when the market is complacent, you generally want to be a buyer because you're buying those options on sale.
This leads us perfectly into our last big section, segment 8, the ROI analysis. The psychology of being a buyer versus being a seller.
As a buyer, you have a big choice to make. You have to choose your strike price. Do you buy an option that is deep in the money or one that is deep out of the money?
The deep out of the money option is the lottery ticket, right? The hero or zero trade that people love to post screenshots of.
That's the one. It's very cheap. You can buy hundreds of them for a small amount of money. If the market makes an explosive, unexpected move at 10%, you might make a 1,000% return on your investment.
But what's the probability of that happening?
What's the probability of that happening? Terrible. The delta is extremely low, maybe 0.1 or less. Most of these options expire completely worthless. If you do it blindly over and over, it's a negative expectancy trade. The odds are heavily against you.
And what about buying a deep in the money option?
It's the opposite. It's boring. It costs a lot more, almost as much as the stock itself. It acts very much like the stock, with a high delta.
Right.
You won't make 1,000%, but you have a much higher probability of keeping your capital and making a reasonable profit.
Okay, now let's put on the seller's hat. The casino. What are they looking for?
They love selling those OTM options. They love selling that hope to the gamblers, but they need a margin of safety.
Explain what you mean by that.
They want to sell a strike price that is far enough away from the current market price that even if the market moves a little bit, it won't reach their strike. They want to collect the premium and then just have that option expire worthless, never hearing from the buyer again.
So they are picking up those pennies, but they are trying to do it from miles away from the steamroller.
Exactly. And they use higher for their advantage. They wait for the market to panic, for IB to spike. Then they step in and sell those expensive premiums to the fearful masses, waiting for the inevitable IV crush.
It really is a completely different mindset. The buyer is paying for a thrill and a dream. The seller is running an actuarial business based on probabilities and time decay.
And that is the biggest takeaway from Chapter 4. It's about these two opposing forces.
Let's wrap this up with the outro then. We've covered a lot of ground. Rights versus obligations, the melting ice cube of time decay, the speed of delta, the fear of vega.
It's a very heavy chapter. But if you take one single thing away from this whole discussion, let it be the concept of asymmetry.
Breaking that linear one-to-one link.
Yes, stocks and futures are linear. Options allow you to deaden the line. They allow you to construct a payoff profile that fits your specific view of the world, whether you want to hedge an entire portfolio, speculate on a crash, or just earn steady income from a flat, boring market.
It turns the market from a game of checkers into a game of 3D chess.
It does. But you have to know the rules of all the pieces, or the board will eat you alive.
So here is the final provocative thought for our listeners to take away. We talked a lot about the gambler in the casino.
I want you to look at your own trading personality. Most people instinctively want to be the buyer. Why? Because unlimited profit sounds sexy. It's exciting. But the professionals, the institutions, they are almost always the sellers.
They are the ones selling the shovels during the gold rush.
Precisely. So ask yourself this question. Are you wired to pay for the chance to win big? Or are you disciplined enough to take on the defined risk of ruin in exchange for a high probability of steady, boring income?
The answer might surprise you. Next time on the deep dive, we're going to take these Legos, the calls and the puts, and we're going to start building castles. We're talking spreads, straddles, strangles, all the complex strategies.
It gets a bit more technical, but that is where the real power and strategy of options trading lives.
Until then, keep your delta positive and your theta.
Oh, make sure you manage your theta. Thanks for listening.
Take care.